Sanjeev Prasad of Kotak Institutional Equities is with us now. Sanjeev, morning. Good to see you again. What have you made of earnings season so far? I mean, have you upgraded your IT earnings, for example, the frontline IT? Did you like them?
Yeah, so far so good. We have seen a decent set of numbers from the two IT companies reported, Infosys and TCS, where the volume growth numbers surprised on the upside on a Q-on-Q basis. Similarly, the private banks have also done pretty well with some expansion in the NIMs, more coming on the back of a pretty sharp decline in the borrowing costs, so that's also helped. And also GAIL reported a pretty decent set of numbers yesterday. So in general, so far we have seen most companies beating the numbers, not by a large amount, but in general, yes. And the only sector which I think which has disappointed so far marginally is the cement sector, but otherwise I think the results on an overall basis are pretty good.
You had actually penciled in for your universe about a 15% kind of year-on-year growth in earnings. From the first few that you've seen, does it look like that number could be closer to 20%?
I would think so. Looking at the fact that in general most of the large cap names are doing remarkably well and better than our estimates, I would think that you would see some amount of positive surprise on overall basis. Let's see the other ones which report. Obviously the companies which were supposed to do well, they have reported earlier, the tech companies and the private banks. So let's see, what happens to the energy names, which are also a larger component of the index numbers.
You spoke about private banks. They have reported good numbers. The one PSU bank which is reported is UCO Bank, and PSU banks is the one space which is supposed to lag this quarter because of what happened in the bond market. Can there be surprises from the larger PSU banks?
It's a difficult call because it's not as if the yields have moved up a lot in this quarter. So, and there is always some amount of flexibility to manage numbers. The bigger issue I think will be to what's happening on the NPL side, and if there is a big amount of increase over there, then that could be a dampener. But otherwise, I don't think there will be too much of an impact as far as the bond portfolio impact is concerned in this particular quarter. So that the more important figure to watch out is what's happening on the NPL side.
There have been a couple of off-center stocks like Sesa Goa and Z which have announced. Have you had a cursory look at those numbers?
Just a cursory look, unfortunately, because these numbers came out pretty late last night. But Sesa, what I saw was the volume numbers have surprised a lot on the upside compared to the second quarter numbers and what we were also building in. So that's the prime reason for the divergence. The numbers are pretty strong compared to what we had built in. Z is pretty much in line. We had 1.15 billion rupees of net income, without any extraordinary impact or anything. And the company has pretty much reported that if you exclude the one-off tax provision which has written back. So otherwise, I think these numbers are pretty much in line.
What did you make of JP Associates, which came earlier in the day yesterday?
Pretty decent set of numbers, I thought. I mean, obviously beta numbers quite handsomely, but it's more coming on the construction side, where I think the reported number was about 16 billion of revenues compared to 13 billion which we had built in, and that was a pretty big surprise. And the EBIT margin also improved quite smartly to about 25%. But keep in mind the fact that these numbers will be somewhat volatile, both on the construction side as well as the real estate side as far as JP is concerned, and somewhat difficult to factor this on a quarterly basis. We have increased our target price for JP on the back of somewhat positive numbers, about 170 from 165 which we had earlier. So that's a little bit of a positive momentum over there.
Can GAIL support a higher price because of the numbers or the surprise that they delivered yesterday?
I think there are bigger issues facing this entire sector, and the one big issue is what's happening on the subsidy side. If you recollect, GAIL has booked about 4.5 billion of subsidy losses in this quarter. We don't know what happens in the fourth quarter, particularly given the fact that there is still a fair amount of uncertainty about the entire subsidy sharing mechanism for this year. If you see our overall numbers for total recoveries for the full year would be somewhere about 450 billion rupees. So far it looks like the finance ministry will compensate only about 120 billion rupees, compared to about 310 billion rupees which would happen in the normal course events if the finance ministry was supposed to compensate for the entire under recovery on the cooking fuel side, which means you're left with a pretty large gap of about 330 billion rupees. I hope some more amount of oil bonds or cash comes in the fourth quarter. But if it's not the case, then you're looking at a situation where the net under recovery, that is the gross minus the amount of compensation of the government, would be of the order of about 330 billion rupees, which is about double what we have built in, or actually more than double what we have built in. Now the problem is who bears the amount in that case. Clearly the downstream companies can't bear it. So I won't be surprised if some amount of the net under recoveries is also allocated to the upstream companies, in which case it becomes a big surprise or a negative surprise for the market. So far we have all assumed that upstream companies only bear the under recovery in auto fuels, but I won't be surprised if some portion of the cooking fuels are also passed on to the upstream companies. So, third quarter numbers were good, but you have a larger issue out there on fourth quarter numbers and even beyond, because you're completely exposed to crude prices in the absence of a transparent sharing system.
So what would that make you more negative on? Would it be fears of a higher subsidy sharing burden on ONGC, which would make you downgrade that stock, or the oil marketing companies, which will probably now get much lower subsidy overall, where you would get more cautious or circumspect on?
I think all the government-owned companies could suffer in this kind of scenario, because the first bigger issue is the problem is you don't have any earnings visibility in that case, because somehow the petroleum ministry will have to juggle the numbers. So if you look at this year, for example, assuming the finance minister gives only 120 billion rupees of compensation, whether it's cash, oil bonds, we don't know. In that case, you're looking at about 330 billion rupees, which is a pretty large number. And how this gets allocated between the 6 government-owned companies, 3 downstream, 3 upstream, we'll have to wait and see. I mean, clearly the downstream companies don't have the capacity to bear this much amount. So I assume some amount will be allocated to the upstream companies, even out of the cooking fuel under recovery. So that is the whole problem. First thing is uncertainty. Second thing is the amount itself, which when you look forward, if you're looking at much higher crude prices in say fiscal 2011 compared to 2010, then you have a bigger problem in 2011 in the absence of any clarity as to what's going to happen eventually. Look at the average prices for 2010 on a say dated Brent basis, that would be somewhere about $67.5 a barrel. 2011 it could be 75, 80, who knows, that's a function of what's happening globally. And suddenly you have the entire sector exposed to, first of all, a larger amount of under recovery, and the second problem is how is this amount allocated between various companies. So it's the whole sector is actually could get derated if this thing continues and if there is no clarity on the sharing system.
The entire space which was on fire yesterday, Sanjeev, was the PSU lot, perhaps in hopes of bigger divestment going forward. Do you think there could be more FPOs on a lot of the public sector companies and larger dividend payouts like has been announced with Engineers India Limited?
It's very hard to comment on some of these names because we don't follow them, and many of these companies have very limited free float. So how much of the current stock price is reflective of the fundamentals, it's very difficult for me to comment. I don't obviously rule out much higher amount of divestment or dividend payout from these companies, given the government fiscal position. But whether the stock prices are reflective of the fundamentals of companies, that's a different call. We'll have to wait and see. Once we have this under coverage and we have more data on this company, then only we can take a call.
Sure.